one of the aspect what I talked to you about, I missed out when I talk about the debt holder. Yesterday I started talking about the debt holder. We said that I also need to look at what is called as debt by equity ratio. Because why do I need to look at the debt by equity? I need to know in a capital there are two components, one component is the debt, another component is the equity. Now I need to know what is the percentage of debt in the company and what is the percentage of equity in the company. Debt holders are who? The loan provider, the people who have provided loan to the company. The people who have provided loan to the company are not the decision makers. Who are the decision makers? Basically the equity holder. They will appoint a manager or they decide to appoint a manager, whatever it is. The equity holders decide the fate of the company day to day. Now you can argue, sir, I have a Reliance share of Reliance or whatever. Now I am not making the decision for Reliance, somebody else is making, agreed. But as a shareholder you have a representative who is basically on the board out there, and there is a majority holder. You hold 1 share or 2 shares or 100 shares or few hundred shares out there, there is a majority holder who is basically looking at making the decisions in the basically as far as the company is concerned. That is what we call as equity. Equity is you are the owner of the company. Equity is nothing but share capital. I would have used the word share capital, that is 10,000 shares at 10 rupees denominated as 1 lakh. That is what we have used it n number of times. That is what we call it as, that entire lot is we call it as equity. Now as a debt provider I need to know what is equity. Supposing I start a company, I say the capital, the total capital, when I say capital I mean debt plus equity. When I say capital I mean debt plus equity. Please understand, when I say capital it is not only equity. When I talk about capital per se, imagine the capital required for my company is 100 lakhs or say let us say 15 lakhs, 15 lakhs. I say that I have about 10,000 shares of 10 rupees each, that is 1 lakh, and the other 14 lakhs I am borrowing from him, or he is a banker, I am borrowing from him. Now what is happening? I make a decision, I have contributed in the capital, total capital of 15 lakhs. What is my contribution? My contribution is less than 1%, less than 10% out there, but I am making the decision, whereas he has put in about what is called as almost about more than 90% of the money, and he has no say in the firm out there. Am I with you on this? So basically what happens, what will be my first objective? My first objective is to first recover my 1 lakh whatever I have put in, and then badme jaye business. That is the kind of attitude basically that. So I mean general. So what we are looking at? We are looking at what is, as a debt person who is providing the debt in the company, you will also be worried about what is the percentage of debt already existing. If the percentage of debt is only 10% in the company, 90% is equity, you may to say the person who has put in a lot of money has a lot of interest in the firm, so I can contribute some more because he will certainly run it. If the debt component is already 50%, by adding more debt into the firm, what is happening? The debt equity ratio will get a little skewed, debt component will increase, then what happens is your risk, what happens, that is what we talk about risk out there. I bring the concept of risk out here. The risk what the debt holder assumes will be higher in the process. So you need to know what is the percentage of debt and equity also in the company out there. Am I with you on this? Yes, doctor. There is no threshold per se, it depends, varies. For example, when I am looking at refinery kind of a situation, the kind of debt will be very, very huge. If I am looking at a service industry, the kind of debt will be could be very, very low in the process, because, or if I look at a simple thing like an airport project, the kind of debt component is going to be very, very huge initially, and over a period of time it gets weighted out. So it is very difficult to have a single point of it. It sort of varies with the industry, varies with the scale of operation also what you are looking at out there. But in general, debt and equity has what is called as an issue out there. Now, which is cheaper? Debt is cheaper or equity is cheaper for a company? Theoretically, debt is cheaper, equity is cheaper. Why equity is cheaper and why debt is cheaper? Let me finish with him first. Equity does not carry a cost, accepted, sir. Debt carries an interest cost, so naturally debt is costly, that is what you say. I agree. Now, doesn't mean I am not going to agree with her, but let me hear from her also. 1 second, sir. Yes, ma'am. You, you know somewhere. Okay, fine. I still give it to you. Yes, sir? Element of risk is very high where? Equity is a share, everyone takes it. Now let me sort of try and see if I can put some numbers to it and sort of try and explain. Now let us take case A and case B, two companies. Company A has equity of about $100 out there. Company B has an equity of $60 out there. And then company A has a debt of blob out there 0. Company B has a debt of $40 and the debt cost of debt is, let us say, 8%. Or even if I have to put it for a simpler, easier calculation, let us just maybe just put it as 10%, whereas round figures easy to multiply for me. Now, so 10%. Now what is happening? The capital for both the companies is exactly the same. The capital has not changed. Am I with you or not? Now let us sort of look at it. The next stage when I go into what I call it as, now the kind of profit before interest and tax, because both the companies are exactly in the same kind of an operation, they are not very different, they are exactly in the same kind of business what they are doing. The profit before interest and tax of both the companies is $20. Now let me say interest component, interest is only on the debt, not an equity. What you pay an equity is what is called as dividend out there. So interest component for company A is blob 0. For company B, it is 10% of 40, that is $4 will basically be the interest component out there. Now if I say PBT, that is profit before tax, in this case it is $20, in this case it is $16 out there. Now I have the tax component in the process. Again, for ease of multiplication, I will just keep the tax as 50%. I mean, you can take whatever percentage you want. I will say out here tax goes of $10 out here, tax goes as $8 out here, then what is called as the PAT, that is profit after tax, which belongs to the equity holders, is $10 out here and $8 here. Now what is the investment in company A? The investment in company A, let us look at only the investment, let us not look at equity, debt component, difference between that, all that. Let us look at the investment. What is the investment in company A? The company A, if you look at the kind of investment what you have made $100 as the investment. What is the return you got? You got a return of $10. Company B, what is the investment you have made? You have made the same $10. What is the return? Some same $100 you got, 60 plus 40, $100. What is the return you got? Return you got is $8 for equity, $4 for debt, that is $12 you got, what is called as the return, total return. That is $4 I am giving it for the debt holders, $8 I am giving it for the equity holders out there. Now what is happening? The return on investment, when I say return on investment, the investment is $100 in both. The return on investment in company A is only about what you call it as $10, whereas in company B is because it's about $12 out there. Now why does it happen? Is it because company B is more efficient? Why? You basically what happens is debt interest is always pre-tax. See what has happened out here. I have taken $4 out there, which is debt interest, which is before I deduct what is called as the taxes out there. Equity in dividend is always post-tax. Debt interest is always pre-tax in the process. So that extra $2 you are getting out here in this particular case of what you call it as in the case of B, I am getting that extra $2 out here because 8 plus 4, $12 I am getting. Why I am getting the $12? Because on these $4 what I have knocked off as interest, I have not paid tax. If I had paid tax, how much I would have paid? I would have paid $2 as tax out there. Because if I had paid $2 as tax, what would have got added? Only $2 would have got added, it would be the same $10. Because I am paying what is called as debt interest before the taxes, then what happens? I save on that, and that is why it is basically $12 is the total return out there. Any questions at this stage? I have still not answered the question what I asked. Yes, doctor. All of them belongs to equity holder. No, that is, it belongs to the equity holder. Principal return, we will look at it later. As of today, it belongs to the equity holder. Principal, for example, I may have to return the principal only after 10 years.
In that case, this is disproportionate return. You have put only 60 and you get 10. Here you have put 100 and you get
Well, that is return to the equity holders might be varying. What is the kind of return? That is $100 I have put and $10 is the return. What is the percentage? 10%. Here it is 60, it is 8. It can be slightly more. Perfectly all right. But my total return, I said I am not differentiating between equity and debt holder out here. That is because you are getting a higher return here, because the return taken by the debt holder is less compared to the equity holder out there. I will come to that aspect of it a little later. We are looking at overall return. If you look at the overall return, one second sir. If I look at the overall return out here, debt interest is always what is called as pre-tax. So what happens for a company per se, theoretically, let me rephrase the word theoretically, debt will always be a cheaper source of capital for you. Number one, debt interest will always be relatively lower to equity, number one. Number two, your debt interest, the return what you pay to the debt holder, you save on taxes. You don't pay taxes on the return that you pay to the debt holders, theoretically. Now, somebody can argue like what he said, sir, equity holder, I am not obligated to give him the return. Whereas what is called dividend, I am not obligated to give dividend, whereas for a debt holder I am obligated to give interest, accepted. But equity holder will have to get a return in some form or the other, either in this form or you retain it, then you give a bonus share, some form or the other you sort of give it. So that is where I qualified my statement when I said theoretically. Your question sir? Return on investment. Now, what is the investment in company A, sir? $100. What is the investment in company B? $100. What is the kind of return, that is what is the kind of benefit or what is the kind of gain, if I have to use the word, what is the kind of gain I am getting for an investment of $100 in the case A? I am getting only $10. In the case of case B, what is the kind of gain I am getting? Gain. Let me use the word gain out here. 8 plus 4, because please note, there are this $100 is in the here focus here sir, the $100 is in the form of equity and debt. For the debt holder I am giving $4 out here every year, that is what is called as interest on the debt out there, because debt holder is charging a 10% interest. So overall for the capital, total capital, when I say what is the return, I am giving $4 to these fellows and pushing them out, and for these fellows I will give the remaining $8 out there. Am I with you on this? So that is what we call it. When I say return is this plus what is called as the $8. That is what is the return out there. We are not concerned about equity or debt. We are concerned about the return on investment as of now. We will come to the equity holder in a few minutes, sir. When I started off with a concern for the debt holder. I did not even start off with a concern for equity. We will look at the return on investment. Then we will come to the next aspect of it. Am I with you? As of now, I am looking at total. See, imagine you want to buy the company out. Imagine there is a company, he is running the company with 40 debt and 60 equity. I want to buy out the company today. Once I buy out the company, I can change what is called as the capital structure. This is what the debt and equity is, what we call it as capital structure of the company. What is the capital structure of the company? 60% is equity, 40% is debt, that is a capital structure. In the first case, what is the capital structure of the company? 100% equity, that is the capital structure of the company. Now that is the capital structure. Now once I buy the company, I may pay off all the debt and make it 100% equity. Agreed? Possible? Or I might say I will take more debt into the firm. I will say only 50% equity, I will take more debt also, I can borrow if somebody is prepared to give me. So I can change the capital structure once I buy out, but I need to know what is the return the company is giving on the investment, return on what is called as the total investment out there. Am I communicating? Not still? Yeah. Why are you more interested? No, we are not interested. I am not interested. I might be a debt provider. He is a banker sitting here. He is not interested in the equity provider. He is interested in getting his money back. Am I right? Because as a banker, he gives a loan. And what is he interested? He is not interested in how the equity holder is performing. The moment he gives a loan, equity holder is happy because he is getting more money to play around. But what is he interested? He is interested in getting his money back. Why is State Bank of India fighting with Vijay Mallya? Not interested in equity, interested in the debt what they have given, loan. So we are looking at, one second ma'am, we are looking at total capital. We are not, I am not distinguishing between a debt holder and a equity holder as of now. Let us not distinguish that. We will distinguish that in a few minutes from now. We are looking at total return on the capital. With you sir? Yes Smita?
Interest paid, right, that $4. So how can that be treated as a gain? It's payment made to
Payment made
the
to what?
to the debt.
Now imagine these are 60 guys out here, 40 guys out here. There are 100 people out here. These 100 people out here I have to pay the $10. Here for the 40 people I have paid the $4. I have pushed the 40 people out. Now I have to work only with 60 people, right? So basically it is to the capital. It is a return. We are even that $8 you can pay as dividends. You can pay as dividends to the equity holder. So even then the money has gone out. But how much are they getting for the investment? Right, you are investing in a State Bank of India fixed deposit. What is the return you are getting? 6% or 7%. That is what I am interested in. That is all. Right, Smita? Any other question at this stage? So theoretically, if you look at, again I repeat, debt is always cheaper for the company. Why? Because you save on tax. You don't have to pay tax as such. Theoretically, again I qualify theoretically. Everybody will say then, if debt is cheaper, then why not? Every 100 companies will all operate with 100% debt. That is why theoretically. Now normally what happens? The second stage what you look at is, doctor pointed out, there is a small difference. That is, now in this case for the equity of $100, the return is $10, that is 10%. In the second case, equity is only $60. What is the return? $8. Why?
Because the tax.
Tax is agreed, that is one part of it. Now come to the risk aspect of it. Now I will address his question also, interest and equity holder. Huh? No, adding chodo, risk.
Means the loss has to be borne by the equity holder.
Debt, perfectly alright. Now, moment debt component comes into the capital structure, the risk of the equity holder always increases. If the risk of the equity holder increases, they expect, I will show it with an example. The expected return of the equity holders will also increase. Now I will explain the same thing with the help of an example. Now imagine the case B out here, whatever you have done out here, case B. Now there is, in the next year, there is what is called as, there is a recession in the economy. You know what is recession? Because of recession in the economy, the profit before interest and tax drops out there for both the companies out there. For both the companies it drops from $20 what it was, it drops to about $6 out here. Now what happens? The interest component in this case is blob, interest component in this case is $4 out here. Then what happens? The profit before tax will be $6 out here, will be $2 out here. Now I will say there is a tax of same 50% out here, $3 goes as tax, $1 goes as tax out here, and then the profit after tax, $3 comes to equity holder, only $1 comes to equity holder. Now calculate the returns, return on the investment. In the case of a downturn, the equity holder, that is the velocity of change, that is earlier case they were getting an interest rate of which is higher than 10%. In this case the kind of drop what you see in the case B on the interest return actually is substantially larger. So what I am looking at, with the risk assumed by the equity holder is higher, because why? In the case A, whatever is the profit or loss equally distributed between the 100 fellows who have provided capital. Imagine each one has provided 1 rupee. In the second case what happened? That 100 fellows are divided as 40 debt provider, 60 equity provider. The debt provider are happy, laughing, whether it is loss, whether it is profit, their return is unaffected. Who bears the loss? Equity holders bears the loss in the process of the debt. So what happens? Debt, though it is cheaper, actually what happens? As you increase the debt component, the equity fellows are always boiling because their risk always keeps increasing. When their risk keeps increasing, their expected return will also increase. Now I use the word expected return, you will learn more in finance 1. Expected return will also keep increasing. Am I with you on this? This risk return relationship, that is where we will say higher the risk, higher the expected return, because higher the risk, higher the expected return. So because equity holders are assuming more risk, their expectation of return is going to be higher. So what happens, as you said in that case, he said, and doctor said initially it's a little unfair. Yes, because why it is unfair? Because there is a debt component, then the risk of the equity holder always increases. Now have I addressed your question a little more in detail? Yes, no sir, and where is the doubt? You ask me, I can spend more time. I am able to keep it a little interesting today? Okay, fine. Now these are practical issues, yeah. Thank you sir.
Sir, debt holders will not have.
1 second, I will just come to you, yeah. Number 6, 6 is basically the profit what you have made in the company as of now. Because there is recession, now in the earlier case what happened? You made about $20 as the profit before interest and tax. Now what is happening? Because there is recession in the economy, I am making only $6. If the recession in the economy, who bears the risk? Equity holder bears the risk, debt holder does not even bear the risk out there. Am I with you on this? So what happens? That is what then there, because they bear the risk, their expected return also increases. That is where when the debt component is there in the firm, the return for the equity holder could basically change out there. Yes sir.
Debt holders will not have control on the company decisions.
Debt holders normally will not have control on the company, they will have no voting right. They might have a representation on the board, because if a banker provides a huge loan, then I forcibly have to keep a banker on the board, that is all. Otherwise voting right, the equity holder, they will decide the future and fate of the company. Debt holder can keep raising objections. I never said that interest component is always less than tax percentage. Yeah, I mean obviously, right, your debt interest cannot be, if your debt interest is 40%, then it is not viable for you to run the company, because no company is going to give you a return of 40-50% consistently for time immemorial. 1 year, yes. So obviously it will be. In this case I just took roughly 50%, you can take 30% and try, it is not going to be very different out there. And debt, moment debt becomes what is called as, if you look at, I am talking about the 80s manufacturing regime, even then the debt interest was about 18% max, 18-19%. Today you are talking about debt of about 8%, and especially when you are looking at raising the debt in Japan or Thailand or one of these East Asian countries out there, you raise debt at about 1%, 1.5%, maximum 2%, touch wood, and with a forward cover provided by bankers, landing cost will not be more than 6% out there. Why forward cover and other things? Digressing a minute, let me also explain. Now when I borrow, loan debt is always, for example, imagine I am borrowing from Japan, I am borrowing about let us say $10 million from Japan. When I borrow from Japan, $10 million from Japan, again not part of your syllabus, only digressing, this is only part of knowledge. Now when I am sort of borrowing $10 million from Japan, I want the $10 million, whereas when Japan dispenses the money, Japan is not going to dispense $10 million, they are going to dispense so much million yen or billion yen or trillion yen, whatever you call it, because yen thing, which if converted will become $10 million, and the $10 million will further get converted again to INR and land in my account out there. Now when I return the money, please note, I will have to return so many INR, if converted to dollar and then further back converted to so many yen, should exactly be equal to the yen which was dispensed by what is called as Japan when they gave me the debt out there. So what are you looking at? You are looking at two conversions, one is yen to dollar, second is dollar to INR. So currencies fluctuation can be favorable, unfavorable, and every time you service the loan also. For example, they are expecting a say 2% interest on that. The amount of 2% interest, the amount of INR you will have to dispense, if converted to dollar and then again converted to what is called as your your N should exactly be equal to 2% of their money which they dispense. So, that to take care of all that is what bankers give, what you call it as the forward cover. They give what is called as forward cover. Charges for forward cover will be far costlier than the cost of loan itself. Loan will be only 1 or 2%, forward cover will always be about 5 to 6%, 6%, around 6% is a forward cover. That is a part of it. Anyway, this is only part of knowledge, not part of the exam. Don't worry about it. If you have understood, fine. If you have not understood, don't worry.
Small question on this. In case of the conversion charges, do the company
No conversion, it's all forward cover, that's all. They are covering you for the risk.
you are paying interest,
Yeah.
you are paying interest, you have to bother about the conversion.
No, you don't bother. That is what I said. That is why he is giving you that forward cover. When he gives you that 6% out here, when he gives you that 6% interest or whatever it is, 6% is the forward cover, that they assume that what are you doing? You are transferring the risk to them. That's all. Let us leave it there.
In case of benefit or loss, bank bears, not the
Obviously, benefit bank bears, loss also bank bears. I mean, that's obvious basically. That is the thing. Now, anyway, forget about the capital structure part of it. You got to know basically debt equity part of it, how does it work. We talked about return on the investment out there. Now, return on the investment, when I, for example, now I will say I am just going to erase this part of it. Because I need to continue from the, yeah, fine. Now, let us look at it. Now, what happens in this, let us take this case itself. $20 is fine, and then if I have to look at the return on my investment out there, return on my investment ROI, when I say return on my investment for company A return on investment is $10 for an investment of $100. Whereas for company B, if I look at what happens is, I will say for company B, I will say it is $4 plus another $8 and the investment is 60 plus $40, that is $100 out here. Now, what will you conclude? You will conclude that company B is better than company A. Am I with you or not? Yes or no? Yes. Why are you concluding that? Why is it better? It is not better because of its operation, it is better because of its capital structure. Capital structure can keep changing. Capital structure can keep changing. Today he has a 60-40 debt. Tomorrow I buy his company, I will make it 100% equity. Moment I make it 100% equity, the performance will go down. So, we are not looking at that. We are looking at what is called as the performance based purely on what is called as the operations. Because when you are valuing the company, when you are comparing companies out there, or when you want to buy out companies, you are buying out companies not because of their capital structure, you are buying out companies purely because of their core operations out there. So, now what is it? Now, in this particular case, when I talk about return on investment out here, this $4 that is paid out here, this $4 that is basically paid to the debt holder is before taxes. That is where it is efficient. I want to take out that advantage of the taxes that is given to the debt holder out there when I am comparing or calculating the return on investment from the operations part of it. So, what do? I say this $4 which was paid for what is called as the debt holders, let me remove the tax advantage out there. Let me remove the tax advantage out there, and then what is there for the equity holders out there, and then I can basically look at what is called as calculating my return. Now, if you look at what have I done, that $4 is before tax. I have knocked out the tax advantage. 1 minus T is 1 minus tax rate, whatever is the tax rate. In this case 50%, it is the same if it is 30% out there. I knock out the tax advantage. And then I look at the return out there. When I knock out the tax advantage and look at the return, then it becomes comparable. The two companies become comparable out there. Yes, doctor.
I was just wondering from small scale, if I want to start.
Sure, sir.
If I want 100 rupees,
Uh-huh.
let's say, and I want to start the company with 100 rupees, I would rather put 50 rupees as an equity, and I would loan to my own company 50 rupees. But the
Possible.
returns will be more.
Possible, because agreed, not returns will be more, in the sense, in that case return is not going to be, yeah, in that case you can, if your own company you want to start, I will say only 10 rupees as equity, 90 rupees I will give as debt, right, because obviously, right, 90 rupees I will give as debt because entire thing. But the problem is in India, once you retrieve the interest on the debt, you have to pay tax. The company need not pay tax, you have to pay tax. Whereas dividend, whereas equity dividend in India is exempted from taxes. That, for example, I will say, imagine in the same case, $4 you are given, whatever, $40 you are given as debt, $60 you are given as equity. You are getting $8 return, that is the company is dispensing that dividend you are getting. On these $8, personally as doctor you are not paying interest out there. You are paying taxes on that $4 what you are getting as debt interest out there, personal income tax. If personal income tax is lower than the corporate taxes, then well, you can always do or play around with that advantage. Yes, that is all possible. All that tax planning, we can sort of look at it independently out there. Any other question at this stage? Yes, Joel.
So we have to compare the PBT.
I am looking at PBT is one, PBT is part of it. Now on the PBT is there a tax? There is always a tax out there. So what do I do? On the PBT, now in this particular case what have I done? I have looked at what is the return for the equity holder, I have looked at what is the return for the debt holder, I have knocked out what is the tax out there. So instead of that, I can simply do what I call it as, I can simply, as you rightly said, I can just say PBIT, profit before interest and tax, belongs to whom? To the capital provider, into I just do 1 minus T, that is the tax part of it, and then say I have equity plus debt out there. This will give me what is called as my return on investment out there. Am I with you on this? So far so good? Either I can separate it out and take out the tax on the debt, or I can just do what is called as the total PBIT part of it. Am I right? Okay. I can take it out and then just do the taxes out there. This is what we call it as return on investment. I have the slides, don't even worry about copying. I have the slides for all these things which I will provide. I will load it on Moodle. I will load all these things on Moodle also for you guys. You don't need to worry about all these ratios. I can load all these things on Moodle, so you don't have to worry about it. That's all what I wanted to convey. Yeah, yes, Rishabh. EBIT, yeah, earnings before interest and tax, I will say profit. I mean, for example, when we say share capital, they will say equity, synonymously used. When I say earnings before interest and tax, the textbook will say profit before interest and tax, whereas if you look at a company's financials, they will say EBIT, they will even say EBITDA, they will again, it will go on. So let's, all that usage we will sort of get accustomed to it as we go along. Am I with you on this? Now what did I do? I looked at two aspects. I looked at the first debt and equity component. For example, if I am a debt holder, if I am going to provide debt for the company, I look at three things. Yesterday I talked to you about interest coverage ratio, I talked to you about the interest. I look at the debt and equity part of it. Third, I look at what is called as the return on investment part of it. Am I with you as a debt provider? Now if I sort of move from a debt provider to what is called as an equity provider out there.